climate and resilience session. Thanks for joining. We've got a couple of workshop-like panels. These are not really meant to be, not meant really to be talking to you. It's really meant to be a workshop. And the way the day is structured this year is the afternoon session on climate and resilience will build on these two topics. And the first topic is loosely formed around sort of the client investor perspective. And the next panel discussion is really focused on the investment perspective. So we are short on time because we're supposed to try to get back on schedule. So I'm just going to turn it right over to the panelists to introduce their teams. Thanks.
Thank you, David. And actually, we're going to introduce ourselves through our comments. I think you have everybody's bios and affiliations in the material that was emailed out. And it's a small group, so come up and find us later at the workshop. I'm Margot Kane, and we have a great set of folks to chat here today. We've got Christy to my left, Christy Zarkovich, Leah Wood, welcome. And we're going to kick it off talking about the supply side and how it's responding to the messages which are increasingly frequent and increasingly urgent about the need for radical and transformational change in pretty much every sector of society in order to prevent or slow potentially catastrophic change related to global warming and natural resource depletion. And yet the response so far in the investment world, as well as other sectors, has been largely incremental and gradual. So we're going to share a little bit of what we see in terms of investor and asset owner preferences and behaviors, where they're taking action, where they're not, why perhaps, our best guesses, where are they able to really place their trust in their investments and where they may be frustrated. And how does that align with the urgency that we see in the rest of the world? So I'm going to start us off with Christy. Would you mind briefly characterizing Cambridge Associates clients and the investors that you work with, and where do you see momentum building for environmental strategies and investments?
Yeah, so I think many of you may know Cambridge, so I'll keep it brief. We're an asset management firm, but we primarily work with foundations, endowments, families, and corporate pension plans in sort of an advisory or sort of OCIO capacity to build portfolios. We do manager diligence, asset allocation, investment policies. So that's sort of who we are. Our client base that is largely focused on sort of climate and resiliency is still pretty much concentrated, this won't be surprising to this audience, in families and foundations. So I think that that's historically sort of where we have seen the most momentum and most capital deployed sort of for the topic of today, those groups of organizations. And candidly sort of at lower dollar figures, definitely compared to sort of the broader Cambridge sort of client base. So that's sort of about 20% is sort of what we would sort of say is impact-oriented of some sort. So I think the growing momentum and the change we are just starting to see, and this will get into some of our comments about products, is we are starting to see sort of those sort of interested parties, those that are not sort of self-identified as impact or self-identified as sort of environmental or climate investors, looking over to sort of see what is going on in more impact-oriented portfolios or impact-oriented manager and diligence work, to just sort of see if they can diversify portfolios, what's interesting, are there new investment opportunities? What we're not seeing is sort of climate, we see very, very few climate-specific investment mandates. So we do have a couple, but they tend to be more environmentally oriented. They are looking across sort of the investment opportunity set, just to be able to, it's broader and less directed. And it's more about sort of the investment opportunity rather than maybe solving the problem.
Okay. So do you think, on the climate question in particular, are investors focused on that when they do have a specific mandate as value creation and new investment opportunities, are they focused on it from a risk management standpoint?
impact, sort of the self-described impact investors that have probably been in the field, again, seriously, for kind of the last probably 3 to 5 years, let's say, are looking for sort of the opportunity. The new momentum is, I think, is absolutely more of a risk diversification. There could be some really interesting upside here. So I would characterize motivations quite different as we sort of see things changing. And again, I'd say we're sort of at an inflection point. It's not clear to me if that momentum that we're seeing in clients is going to persist or what it sort of translates to. It's kind of early days.
Okay. Leah's nodding her head. as Impact, your firm has moved from the EU into the US, and established a foothold here. How would you characterize the kind of different approaches that investors have been taking that you guys have been working with regards to the environment and climate change?
Sure. Quickly on Impact, we are an asset management firm focused on investing in the transition to a more sustainable economy. Our CEO and founder is a scientist by trade, and our flagship strategies are focused on environmental solutions. So we are looking at how companies make their money, and their revenue streams need to be tied to solving some sort of environmental challenge in energy, water, waste, or food and agriculture. So that's the background of the firm. Again, founded 20 years ago in the UK, entered the US market in 2008. I joined 2 years ago. My background was more OCIO consulting, and so I had the benefit of meeting a lot of different asset managers saying that they were doing ESG or solving environmental challenges or greenwashing. We heard all about that this morning. And I had the benefit of getting to meet Impact and really holding them up against all the other asset managers in the space. And I truly believe that Impact is doing it right. So we're actually looking at how companies are making their money and allocating capital specifically to these areas that are significant challenges for us going forward. So our client base in the US, to no surprise, is mostly endowments, foundations, mission-driven investors, religious investors. But increasingly, we're seeing the retail side of the business grow. So significant interest from high net worth individuals as well as millennial investors. And that ties into the DC market as well. So that part is a bit disjointed. I don't know if we'll get into that later. There are ways that I can work a bit better in DC. But our client base, yes, is a bit more mission-driven still. I think we've worked for a very long time on investing in educating the audience that we have here in the US, and that has taken a long time. And we're finally seeing allocations happening. But still, we are a very small part of any institutional investor's portfolio, maybe 2%, 10% at the most. Investors allocate to us in different ways. I think the diversification story is really interesting because environmental solutions companies are very fast-growing companies, and they're very different than a traditional growth equity allocation. So if you think about growth equity, it's a lot of tactics with bank stocks, based. So these companies are small, they're underrepresented, and they need capital. So I think it doesn't need to be so focused. The capital doesn't need to be so focused or mission-driven. It can just be a diversification story. So we're trying really hard to sort of bridge that gap and get into mainstream portfolios with just a traditional growth equity allocation and sort of stripping away that ESG sustainability aspect, because I think that puts us in a small bucket and there's really much more opportunity for broad allocations. So hopefully that answers your question.
Well, I'm gonna skip a little bit here because I think the diversification and potentially countercyclical assets and decoupling from concentrations in other sectors is a really interesting story here, and it's a way you get your foot in the door. Some of the institutional clients. So can you talk a little bit about that, where people are seeking to diversify and where climate-related investment themes and strategies and products come to the table?
Absolutely. I mean, I think there's two things happening. There's sort of this long-term transition away from fossil fuel and into more clean energy. But then there's real climate risk, physical climate risk right now, in terms of the need for investing in resiliency in our cities. So by, climate is much broader than just energy, obviously. There's water, there's waste, and there's all these things we need to figure out. And so investing in infrastructure is really important, and I think there is, unfortunately, more of a realization of that as we have these extreme weather events. And we typically see we've seen a lot more interest in the past year or 2 years since we've had all these hurricanes and significant damage in infrastructure, and the realization that this is our own backyard. We're all in this together. So if we don't invest in this in resiliency, we're going to all have a problem. So I don't know a more pressing place to be allocating at this time for any type of investor. So it's kind of a frustrating thing because I think there's a stigma around returns and around fiduciary duty and all of these things, but as a millennial and as someone that's looking at 2030, 12 years from now, and what the world's going to look like, I think we have a lot to do. And that IPCC report revealed that significantly. I think it was $2.5 trillion a year every year until 2035 if we want to meet 1.5 degrees.
If we want to effort $54 trillion in damage.
Exactly, catastrophic. So
Sorry.
What we should all be trying to figure out today is how are we going to do that. So.
Yeah, and your point about city resiliency, which I think there's a panel going on right now around a workshop in the afternoon in the municipal market. The ratings agencies have come out saying we're going to start taking into account your resiliency plans and your climate risks, but they haven't said how. Right? There's a lot of soft indicators and not a lot of direct guidance or sticks, really, or fires to light under folks. And it's been very interesting to see the diversity of response to that statement amongst municipal issuers and utilities. Paul, you've done a lot of global thinking on this issue, from TED Talks to other endeavors in your own work. How would you shed light on this challenge of moving more institutional capital in particular into positive environmental progress against these goals that we've set as a global community?
Absolutely. It's very simple to me. It's a matter of return. My own background, I spent 20 years in the asset management business, managing funds for institutions, and more recently I've pivoted more towards what people call social impact investing. I'm on the board of Water.org, and I'm a strategic advisor to a new asset management firm that has created called Water Equity. When we go out and we talk to prospective investors, there's this tension between, is it finance first or is it mission first? Is it impact first or is it return? To me, if we're going to do anything meaningful on the kinds of assets and amounts that they mentioned, it has to be about return. We get the same numbers if we look at the Sustainable Development Goals writ large. Ironically, they're very similar. It's about $2.5 trillion a year we would need to achieve the Sustainable Development Goals. An enormous amount. And in my own space, water, we need roughly about 100 billion a year. I know we're all terrible at understanding what these big numbers mean, but just to throw it out there for water, if your whole life represented all of the assets in the world, we could solve the water crisis with just 4 days of your life. So it's a small amount of the total assets in the world is all we would need. But it's a big number when you write it down. So we're going to get 100 billion. It has to come back to returns for me. What we're trying to do at Water.org, it's actually, it echoes some of what we heard in the earlier keynote presentation. We make small loans to mostly women in poor countries to either build a toilet or connect their house to the municipal supply. Typical loan is about $200. Gets paid back over 6 months, and it has an enormous rate of return for those individuals, mostly women, who take advantage of it. But where do we get the capital from? We source the capital from institutional investors. just launched our third fund. It's a $50 million fund. It pays a return, an equity-like return to the investors. We are targeting something like between 7 to 8%. It'll look very like an emerging markets fixed income investment, which is what I spent many years doing. But the deal on the table is absolutely clear. This is an investment that you should consider in your portfolio for the same reasons you would consider any other investment. Its return profile, its risk characteristics, and its diversification coverage. In addition, it has a social impact. And what I'd like to do is pivot the conversations that we have with capital providers away from, hey, show me what you have on the social impact side, to show me what you have in an interesting return space that also has that social impact.
Thank you. So, how much money are you raising in this fund?
Yeah, so this one's 50, and again, there's a lot of parallels with the earlier presentation. And for me, you know, there's a total capacity out there of something like 600 billion or a need. So we have what we like to do is have our fourth and fifth funds get up towards $1 billion, and to be positioning them with the investment consultancies, positioning them with the institutional managers, and making the case. We did talk about greenwashing, really making the case for what the impact is, and being very clear on the measures of success, but not for a minute diluting the message about the return.
So institutional investors are very broad, and it's interesting to hear about what you're doing and thinking about kind of which sectors of investors could participate in something like that, and which cannot. And as this panel sort of represents, whether directly or indirectly, the investor perspective, we hear a lot about the need for investor-ready product. We hear a lot about we have to align to the return, liquidity, risk, and scale expectations. And scale can sometimes be one of the biggest barriers, along with track record. And there's a little bit of a chicken and the egg component in some of these cases. And so, Christy, I'm gonna put you on the spot, since you get to see all of these folks who are trying to raise from your clientele, many of whom have already self-selected into that bucket of, I'm an institutional investor willing to incur a little bit of brain damage for a little bit of extra social impact, but I'm not compromising any of my investment return goals. Right? Where do you see people being successful in accessing that type of institutional capital? And where is their product coming to market with a really compelling value proposition, but they're having trouble raising the funds? And why do you think that is?
Yeah. So we'll start at sort of here, we're seeing real scale. And I think that it is hundreds of millions of dollars raised relatively easily, meaning that once you get past your first close, you know you'll get it within that first year, but you're having your contacts, right? And you're not going to have to.
You're going to have 20.
And so, I mean, those are candidly established asset management firms that have distribution networks, they have clientele, and that is more about two things, right? It's the type of investors who are coming to those large platforms. They have large dollars to deploy. They need to write checks. They just have to. It's not efficient. There's no other options. And they have done the diligence on those platforms. They are comfortable with those platforms. So, no matter what other institutional investors, they have found them institutional rigorous. And in fact, it was interesting. We were talking to one of the large asset managers just the other day, and they had 60% overlap in their labeled impact fund with sort of their growth equity fund. So that just tells you what's happening when you see the headlines about scale and not really some of them. On the smaller end, where you are talking about new teams that haven't worked together, new markets where you're going to have to incur the brain damage, but there is institutional quality around it, right? You can see a path that, yes, you just need to sort of prove this and demonstrate the concept. I definitely think that there's always one or two of those clients that have selected in that want to spend time, but you have to just realize that they can probably only do 3 to 4 of those a year. And so it's not that we aren't seeing, what we see is not successful, it's just a supply demand and time, that time intersection that is going on. And there are, I think we all know, right, those are not all successful, and unfortunately we don't have enough data points yet to say, in the broad scheme of things, if you go outside of impact, these numbers look the same of conventional funds as they do with impact funds. So it's too easy now for people to still sort of highlight on the funds that have not been successful, the funds that have fallen apart. I truly believe the data is going to look just like the broader investment industry. We just don't have enough data points yet.
Right.
Yeah.
Right. The first time fund manager stigma extends into the second time fund manager stigma for many of these firms because of this track record problem and sort of an adage that's going around is once you can raise your third fund, you figured it out.
Yeah.
But it's a pretty big barrier, and there's very few entities that are willing to invest and incubate in new fund managers. I think some of the work that I've been doing with Circulate Capital, which is a spin-out of Closed Partners, is really interesting in that regard because it's bringing in a new source of capital, corporate investment dollars off their balance sheet, for the most part, to build investment capacity in a particular market that today is sort of ignored, which is waste and recycling in emerging markets. In this case, in Southeast Asia, with the goal to remediate the ocean plastic disaster. And these folks have come to the table in a really interesting fashion, which I think distinguishes them from a philanthropic strategy or institutional investor strategy, which is, okay, this is not how we make money. Okay, we're not investors to make money. And we are not doing this for a sole mission or charitable purpose. We are doing this for a lot of reasons, including risk mitigation and improving our supply chains. But also, we want to build a marketplace where institutional money can flow. So they're very deliberate about structuring this to be as kind of catalytic and speaking to eventual institutional money that's possible. And there's not a lot of that in impact space, and it's a very challenging role to play, as many of the foundations who may be here in the room today know, who have done that kind of program-related investing, mission-related investing, can be really challenging. And we're talking a little bit about the overlap and kind of established fund managers and going into impact and being able to raise money really easily relative to some of those folks who come out of the impact sector trying to raise money. And it brings to mind some of the criticisms around the greenwashing conversation, right? And also extends into other markets like green bonds. Leah, you were talking a little bit about the green bond market and how it's appeared in your portfolios and products. Do you want to talk a little bit about that?
Sure, yeah. So Impact's recently acquired Tax World, which is a fund management company based in New Hampshire, and they have several green bond products. And so I've spoken frequently with those portfolio managers. I think there's definitely frustration in terms of the greenwashing, and there's a bit of a reach that goes on when companies are raising capital and labeling something a green bond. I think there's a difference between something that's public transit and something that's dedicated solar deals for a company or water or waste. So I think it's a challenge. We as a fund manager are always trying to encourage our investors to be really discerning about who they're hiring to manage their money, because there's a lot happening right now. I think there's this realization that there's this bubble or a trend around ESG sustainable investing, and so every asset manager in the world is coming out with an ESG product. And it's becoming even harder for investors to really get their money where they want it. I mean, it's just so easy to say, oh, this is an ESG product, I'm doing the right thing. And so it starts with the kind of products and securities that we're investing in. We have to be really discerning about those, and then investors have to be really discerning about the managers that they're hiring in that space to sort of pick the right investments for them. So broad label around everything that I think is frustrating. We really need to, we don't have the time to be, if people want to allocate to this space, it should be much easier and much more clear on how to do that. And I think there's way too much confusion out there. There's a lot of parallel trends. There's labeling issues. There's SRI, ESG. It's just so confusing, and I think it makes it really challenging for a retail investor or just even an institutional investor to find the right place to put their money. And that is just time we don't have. We're really encouraged by a lot of the consulting firms coming and helping investors think about this. And we're encouraged as well by the public plans now moving into the space. I think the frustration that we had in the U.S. is that this is definitely a coastal trend. We're seeing much more happening in California, New York, East Coast, West Coast, but the whole middle of the country is kind of missing from this conversation. And so how can we bring them to the table here? Clients, public plans, DC plans, corporates, everyone. I think it's a huge amount of capital that's kind of missing. So.
And if I were to play the other side of that coin, it may not be a bad thing that money in general is moving towards SDGs and environmental goals, whether or not they go the easiest possible route for allocation, or whether they choose to educate themselves and employ more sophisticated techniques to do it. But we, as practitioners and advisors, it's our job to try to get as much of that movement as possible targeted towards areas that really are starved for capital today, that will have substantial impact while meeting investment goals, because it is not, we'll never be able to solve this problem with the amount of money that's able to deploy the concessionary rate today. It's just not possible. The scale is too large. So, David, how am I doing on time?
5 minutes.
Okay.
Perfect.
So, we're going to close with the final question, which is, going back to the original start of this panel, and if you even were reading the New York Times headlines yesterday, what would need to be true, or what would need to be different in your respective worlds in order for a material shift in how capital is allocated today to reach the goals of the Paris Accords, to reach the Sustainable Development Goals by 2030 or 2040, and prevent some of these huge costs in human life, natural life, and economic prospects that we see coming down. Okay. How do you switch from the incremental to the radical?
So, just to jump in, I would say 2 words: sell side. To me, the sell side has to step up. The function of the sell side is to shrink wrap and package risk that allocators can look at in a sensible way and say, yeah, that's something I want in my portfolio. To me, the sell side is not performing that function. There are many securities that we could think about constructing that would make sense to allocators and would make sense to the causes we're chasing. Things like GDP-linked securities, things that look at the balances held in checking accounts idle in this country, creative packets of risk that we can use to funnel that kind of capital to the interesting and important goals that we have. So very simply, I would like to see the sell side step on.
These guys standing up, yeah.
Right.
Leo?
Yeah, I would say, most of us in this room are financial professionals. I think, one phrase that always rings true to me that we've all heard is our compliance department's kind of breathing down our neck, and every slide has to say, past performance is not indicative of future results. To me, I think that it's just, we cannot keep looking to the past for guidance on how to invest in the future. It's really a challenge. I think this performance stigma has to kind of go away. We have to start thinking and investing in the way we want the world to be, not in the way it has been, where everything is changing. Technology, energy, everything
data we do have on past performance is based on a market that's led us in its extractive short-term investment prices to this very change. Christy?
I mean, I think we hit it, right? I mean, so much of the battle that we're all facing is that first 20 to 30 minutes of a conversation. Sometimes it goes on years of just, what is this? I have found when it is successful, which I'm not pretending over the argument is putting as many tangible, real investment ideas in front of investors with real data. And so, as painful as it is for sort of new, firms to start up, but I just think that the more opportunities we have, the more we're just showing this. It's going to take a while, but I mean, Joyce made it kind of like, there were funds before spring break, like they're great, but I think it has helped make that path a little bit easier in that particular area of the market. I'm not saying it's been easy, but I think we'll see more and more of that trend, right? If you just see more investors are used to it, and you just get past that performance argument, you just need to get past it.
Yeah. And I'm going to go slightly off topic and say, along with all of this, I'd also go for the $27,000 per ton tax on carbon, because that's a great investment market. Everyone, thank you very much.